Okay, everyone, thanks for joining us here. We're just going to be going through each of the examples that you read about in the last lecture and just kind of give a visual representation to make sure that you know exactly what's going on. So, down here at the bottom, we have the three sections: retained earnings and net income, depreciation, and then financing. And so, as I said before, each of these is a good representation of how the three financial statements work together. And as you see here, we have income statement, cash flow statement, and the balance sheet. And it's all tied together, so you can see that there's actually the formulas that will affect the different columns. And what's interesting about this is that basically every section along here, and along here will actually affect each other, and this is the whole point of this section about how each of these works together. And so let's just go through these three examples and then specifically see how the changes are made through each statement. So we'll start with retained earnings, and we have the net earnings down here. And remember how the net earnings, otherwise known as net income, actually affects the retained earnings. You see how these are the same numbers, right? Right here and then right here. And so let's pretend that in year 2, the company had some really solid revenue growth. So it grows almost to 130,000, and boom, we see in red how the net earnings are boosted. So we'll just go back right here. We see 11,000, but then we add on that revenue and we see it shoot up the same amount as what was added on to the revenue. And so going here, we see these net earnings are increased, and over here, it's the same thing. But it also is an increase on the cash flow statement. Because of this, we saw cash from operations increase, and then our closing cash balance also increased. Then this cash balance moves up to the balance sheet, which increased the total assets, which was offset by the increase in the retained earnings. And so the total assets and the total liabilities and shareholders' equity balance. And remember, that's what we need: the assets and the liabilities, and this plus the shareholders' equity to balance, because that is accounting. So we can just see right there that that increase in net earnings led to an increase in cash, which led to an increase in cash on the balance sheet. But then this net earnings also increased the retained earnings of the equity, and so now we're all balanced out. So that's the first example in retained earnings. We could have decreased R&D, we could have increased it. Basically, we could have changed the net earnings any way possible, and it would have flowed through to the cash flow statement and balance sheet as well. Moving on to the second example, we have depreciation. So depreciation is a little bit trickier, but let's jump right in. So we have depreciation right here, depreciation and amortization. And what we're going to do is increase that a little bit. So instead of 19,500, let's go to 22,000. And so what that would actually mean is that the amount of property and equipment is being depreciated at a faster rate. So maybe a new accounting rule came out where they said, oh, your factory, instead of 10 years of useful life, it's actually only 7 or something, and so we had to depreciate it at a faster rate. And so what that does, since it's an expense, it actually increases the expense, which thereby decreases the net earnings. And so a decrease in net earnings over here actually translates to a decrease in retained earnings. And since we had a decrease in retained earnings, on the other side of the balance sheet, we need that to balance out. And so since it's actually an increase in depreciation, we had to depreciate this property faster. So if you see, we go back, so we have 19,500, 38,000, if we just punch in 22,000, we see that property and equipment actually decreases to make up for the decrease in retained earnings. However, what's a little bit trickier because of taxes is this cash from operations. So let's go back and have 19,500, and we see this is added back to net earnings in the cash flow statement because it's a non-cash expense. We don't actually have a cash flow outlay because depreciation is kind of this accrual accounting idea rather than a cash expense. So let's do something real quick. We go 22,000, that decreases the net earnings, and then we see a decrease in net earnings, but it adds back this 22,000. So let's do it without taxes real quick. So without taxes, take that out. Actually, we'll go back to square one with the 19,500. So we have this. Without taxes, this number will actually not change at all because net earnings will just decrease, but then it will be offset by the depreciation. So 22,000 and no change here. However, if we add back the taxes, it changes things a little bit. So 22,000, we see that this actually changes. So this is about 29,900. Before it's about 29,300. So why did that change about 600? And the answer is taxes. So if we think about this, depreciation increases by 2,500, and the tax rate is 25%. So 2,500, 25% is 625, and that's exactly our difference between this number and the one that we got. So that's kind of the deal there. We have to factor in taxes, because if we get a 22,500 increase in depreciation and amortization, some of that is actually taxed. And so the net earnings isn't actually hit as much as the cash flow is added back to it. And so that's kind of the reason why we have that discrepancy. Moving on to our third example, we have financing, and this is just taking on debt. So pretend we had no debt, but in year 2, we take on 20,000 in debt, right? So our cash from financing increases. It doesn't change anything about operations or investing cash flow, but we have an increase in cash flow because of this increase in financing cash flow. And what this does is increases this cash account, which then we need to balance it out. So what happens here is that we have this debt, and we go year 1 plus the amount of debt we took on in year 2. So now we have this 70,000. And as we see here, what happens is now the liabilities and shareholders' equity balances with the assets. But we also have one more thing because it affects the income statement as well. So as we see here, the interest expense on this debt, 50,000 in debt, is actually a 5% interest rate, and so we have to pay out the bank or anybody else that's lending us money, because for them to put up the money, they need to be compensated for that, of course. So we have to actually increase this interest rate. So we start with year 1 plus 5% of the added debt. So just do the debt and then 5%. And so we see that it increases 1,000. And so that actually decreases the net earnings. Also, it's taxed. And then as we see, that net earnings is added back to the cash flow statement. And then finally, it flows through here. And we see once again, because cash was actually decreased a little bit, and so was retained earnings, we see it balance out nicely here. So these are kind of the 3 examples that are really not easy, but it's very apparent how they change the 3 income statements and how it all works together. I hope that was a little bit helpful, kind of seeing this visual representation, but it's just the idea that all 3 of these statements work together, and it's really important to be fluent in this rather than kind of just memorizing. so it's good to understand how each plays off of each other. Hope this helped. Appreciate you.